With that, let's turn to our Lunchtime Stock Club for January 14th, 2019. Let's take a look at the market. Boy, what a close to 2018 we had. I think a lot of people are happy to see 2018 wrapped up and done with. Things were moving along quite well until about September or October, and then the markets just decided to take a little bit of a downturn. Here's the full year of 2018, looking at the three market segments that I like to focus on. The top is the Russell 2000 that was performing quite well by mid-year. The S&P 500 in blue, right below that, again, a little bit of a downturn in February and had recovered nicely going into September. And then the EFA, the Europe, Australasia, Far East Index, having a terrible year. The international developed world markets down 17% for the entire year, compared to 12.5% down for the Russell 2000 small caps and down 7% for the S&P 500. A little bit of an uptick at the end of the year. That final week brought a little bit of relief, and so the index has all bounced back a little bit. But that's been making for a tough year for many investors. And as we entered in 2019, we're actually seeing a little bit of recovery, a little bit of a strength from that decline at the end of the year. That little recovery that kicked off the last week of December has extended into the first 2 weeks here of 2019. And the Russell 2000 up 6.3% from the beginning of the year. It's up a little bit further when if you took the lowest point of 2018. The EFA index and the S&P both up 3.1 to 3.5% year to date. So they've showing at least a little bit of stability. The increased volatility in the market goes without saying, but now we've got a little bit of a basis, I think, on which we can build recovery continuing for the rest of 2019. And when you look at what the analysts on Wall Street are predicting for the year, we'll take a look at that in a minute, and that will show us, give us a little bit of an idea of what we might expect. When we look at the S&P 500 PE ratio, using trailing 12-month estimated earnings, as of today, it's 19.79, and you can see that decline from earlier in this year. It was almost as high as 25, and it's pulled back now considerably. And you can see that red dotted line shows you where the current PE ratio was reached going back to 1870. And so you can see it's not been at all uncommon to have a PE peaking at or above, slightly above where we are now. So that retraction is pretty good. When you look at corporate earnings, that's the other part of the equation. S&P 500 earnings are at an all-time high, again, on a trailing 12-month estimated basis of $130.18. And so, again, representing good strength in the economy, good strength for many large company stocks. Now, will that hold going into 2019? Certainly, we've had some high-profile guidance reduction from companies like Apple, General Motors, the car companies, guiding downward for the year, and that will certainly have some impact on where earnings will be as we continue through the 2019 year. But if we look at the market forecasts and for the S&P 500 and the earnings per share, so the target of the index as well as the estimated earnings for the S&P 500 for the full year of 2019. This is a collection of the targets and earnings projections from the leading investment banks globally. And so you can see the S&P 500 targets range from a low of 2665 to a high of 3250. And for the earnings per share, ranging from a low of $166 all the way up to $178. Well, I did some math and crunched the numbers here. The average target of the S&P 500 is 2992. That represents a 19% gain from where 2018 ended. The highest target for the S&P 500 was a 29.6% gain, and the lowest was just 6.3%. So analysts are looking at the market and believe that conditions are in place for a pretty significant year. Of course, that downturn makes it easy to for a certain amount of gains to come as the market bounces back. When we look at the S&P 500 earnings estimates, based on an estimated earnings for 2018 of $161. And the problem is that all the analysts may look at operating earnings or another flavor of earnings per share. But I'm using $161 as the baseline for the changes. So the average earnings per share estimate was 173.65, up 7.5%. The highest estimate up 10%, the lowest estimate up 2.8%. And so obviously we look and we see there's a little disconnect there, right? We're looking at growth of the stock market up considerably higher than earnings growth for the year. And that says to me that there are likely some scenarios where this sanguine forecast for the S&P 500 could be disappointing for some in some situations. I think we're still in a realm where there's not a lot of alternatives to equities. Bonds are not really at levels yet that are considered desirable. Interest rates, while they're higher, are still a little short of where people would move out of equities wholesale. Obviously, a lot of outflows in the last quarter of the year last year as people did move into cash, but I think a lot of that money came back into the market in January so far. When we look at the economy, there's a lot of talk about recessions, but recessions and bear markets don't always coincide. We've had a bear market, a small cap bear market last year, if we count a 20% decline in the Russell 2000, and now we're recovering out of that. The S&P 500 never went into bear market territory. It corrected, but it never reached that 20% decline from the peak, I think. And so I think it's important for us to separate out the issues of volatility and market risk from economic risk. And the market, if the market goes into turmoil, increased volatility, if the market declines, it's not predictive of a recession. However, on the other hand, if we do have declining earnings that happen during a recession, growth slowing down, that can cause stock prices to fall, and that can in turn lead to a bear market. A lot of economic indicators are continuing to show strength. A lot of bears are disappointed that the market continues to reflect economic strength. Housing starts, for instance, there are some concerns in some sectors that I've been tracking. High-end homes or growth in that sector is slowing down, but people are still taking out mortgages. First-time home buyers are still active, and the home building in the entry-level market is still strong. Manufacturing is strong. Technology stocks have their own cycles. Chip stocks, as always, march to their own beat. Their cycles, of the product cycles in the semiconductor area are unto themselves. And so I think, all in all, there's not a lot of cause for alarm. Tariffs, I think, are still continuing to impede profitability for many companies. And we're going to be feeling that for some time. I don't see any clear signs of resolution that would help. And until things really reach a much more dire state. But I think a lot of companies are suffering, and consumers are going to be feeling the pinch from tariffs and from the increased costs of goods, both on the raw material side and in consumer goods, as we try to limit imports from overseas. Last year was China's biggest year of exporting to the U.S., even with tariffs in place at the end of the year. And Americans' appetite for Chinese-made products and Chinese-made materials hasn't really diminished. And tariffs, are certainly taking a chunk out of that. There are some companies that are going to benefit from tariffs, but the increasing global nature of business, I think, makes these tariffs a short-term solution to a problem that no one else has a clear idea how to address. And so it still remains, in my view, an area of uncertainty as we go along here. So I think all in all, it's good to keep in mind that 2018 is going to be a faded memory 5 years from now. In 2023, we'll barely be able to remember what happened in 2018. We invest for the future. We don't invest for the present. We don't invest for the recent past. We're investing for the long term, and that's our best defense against the gyrations of the market and the turmoil, the political risks that's descended upon us, is to remember that these things will pass. And when we focus on fundamental strength of individual companies, we can identify the winners and the losers in the individual nature of our analysis, and not focus on what's happening in the overall market. And hopefully that will be our key to success. So I wanted to give you a first opportunity to download our new Better Investing in Money Show's Top Picks report for 2019. This includes 100 plus investment ideas for the best stocks for 2019. Everything from conservative dividend stocks to high growth tech companies. There are some ETFs that are covered as well. There's some sector analysis that you'll find in this free report that the Money Show is joined with Better Investing to offer to iClub Central and Better Investing members. This report does include picks from the SmallCap Informer and the Investor Advisory Service. In the 2018 Top Picks report, one of the SmallCap Informer picks that I talked about last month, Emergent Biosolutions, was one of the best performing stocks in the 2018 report. And one of the Investor Advisory Service picks of Ulta Beauty was up 17% for the year, which was a pretty strong performance when the entire market, the market index, is down 17%. So that was some evidence for the companies that were offered by the SmallCap Informer and the Investor Advisory Service as part of this report. To get the report, I can't give you the PDF, but I can give you the address. I'm going to copy and paste this, and I'll put it in the chat box for you all. And you can click on that or write it down. It's bit.ly, that's a URL shortening service, /Top Stocks 2019. And that will get you this report. So here is the link to the free Top Stocks report. And if you miss it, you will have the opportunity to, we're going to certainly give you, we're going to be sending out some emails with links to it as well. So let me just type this in. All right. So I've sent it in the questions box and in the chat window. So you ought to be able to just click on that and quickly download that PDF report. As I said, it's 115 pages, I think. So there's plenty of reading there, plenty of stock ideas for 2019. We're going to be discussing those on our Stock Central website. We're going to be doing some discussions of some of these ideas, and maybe there will be some stocks that you might find interesting. So check it out. Let us know what you think about that report. I wanted to talk about a book that I've been reading. I'm about 2/3 or 3/4 of the way through a really interesting book called Crashed, How a Decade of Financial Crises Changed the World by Adam Tooze. He's a prize-winning economic historian, so his focus is on the history of economics from a global perspective. And he, in this book, talks about how the U.S. financial crisis of 2007, 2008 spiraled around the world, how it impacted the financial markets of the UK and Europe, and extended into Asia, the Middle East, and Latin America. And his contention is that it forced a rearrangement of global governance. And I think as we are now addressing global issues in the American economy with the imposition of tariffs and the renegotiation of trade agreements. This seemed to be a really timely book as it really looks at the intertwined nature of global finance around the world, where what we do in the United States does have an impact on what happens in Europe and what happens in China and what happens in Asia, what happens in other economies, and likewise, what happens there impacts us. We have external investors buying U.S. debt, buying U.S. issued treasury bonds and bills and notes, and that they are impacted by what's happening in our country and our economic policies. And certainly the situations in Greece and some of the other countries in the EU and how they've been, how the EU is addressing those bailouts of those countries and the austerity, what's happening in France even today with the Yellow Vest riots. There are massive changes afoot in the financial systems around the world. And so this is a really interesting perspective now looking back 10 years later at the start of it all, the access to free capital, taking the roadblocks and speed bumps out of global finance and deregulating so many of the markets. So Tooze does have a perspective on the biggest, those who really get singled out for blame, and he levies it across the board. So it's not just the Republicans, and also Angela Merkel, the German premier, and what was happening in England, what happened in Iceland. So a lot of politicians don't show up so well in Tooze's account of financial crises. I think this is probably should be required reading for all of our elected representatives in Washington, and I'm finding it to be it's a rather lengthy book, but I'm finding it to move along quite well. And every chapter there are a few aha moments where he makes something. Makes a comment or an observation that I find really insightful, or that I didn't know about the nature of the financial crises of 2007, 2008, and beyond. So this is again not a book about the stock market, but it's all interconnected in the end, and I'm finding it really enjoyable, really interesting, and thought-provoking. So if you're looking for a book like that, here is a great idea for you. So let's talk now about a small cap stock to study. I talked about a bunch of stocks last month. My top picks for the year. We're actually putting together our own top small cap stock picks for 2019, a special report. But you essentially, folks in our Lunchtime Stock Club, got a free glimpse at all of those companies in our last webinar. If you missed that session, you can go check it out. And I wanted to focus on one of those companies a little more specifically, and that's Ollie's Bargain Outlet. This is a discount store chain focusing on closeout merchandise. It's headquartered in Harrisburg, Pennsylvania. And so they have a big presence in the Northeast and the Mid-Atlantic region so far, but they are aggressively expanding. And the discount store industry is considered a consumer defensive sector stock because during recessions, people continue to shop, but they shift downward. So they spend more time looking at a store like Ollie's, which has pioneered something they call adventure shopping, where you never know what you're going to find. Their motto is good stuff cheap. They provide closeout merchandise that they acquire from other chains and other stores that are shutting down. So for instance, if during the Toys R Us bankruptcy, Ollie's acquired a whole lot of inventory right from the warehouse. They buy it for pennies on the dollar. They turn around and sell it in their stores at a deep discount to the full price, but are still able to make a significant profit from those sales. We focused on it in the SmallCap Informer in December. It was $82 as of our analysis. It had come down quite a bit, maybe $10, a little less than $10 from the all-time high, and it was right at the cusp of my buy zone. So I thought, well, this is the time. We may not have a lot of opportunity to buy Ollie's. It's a little expensive, but I think there's considerable upside beyond our conservative approach. So certainly then as December continued and the market decided to go into a swoon, Ollie's fell to below $62 by December 24th, and by today it's back up to $74. So I think 74 is a lot more attractive than $82 or $86. It's less attractive than when Ollie's was in the low 60s, but that's why it's always important to take a look at companies like that, put them on your watch list, and take advantage of those kinds of opportunities. When you look at the price here, the first on the left is when it was in the SmallCap Informer around November 21st. The issue was published, so the stock was at that point it had bounced back up to about $84, $85. It reached back up to $91, and then it declined pretty precipitously into December. Part of that is on a little bit of reduced guidance, but our judgment in our stock, in the stock study in the SmallCap Informer had already tempered the expectations for growth. So the reduced guidance still fit within our expectations. Other people who had over amplified expectations were disappointed with that a little bit of downward revision. But Ollie's has a history of performing a little bit better than their guidance. So I think the upside potential is still pretty significant. By the time it reached that low price, you can see in that middle arrow, and now it's back up to around $74. If we look at their history, we had data going back to 2013. They went public in 2018, and they've just been very consistently growing. They surpassed $1 billion in revenues in 2017, so it's still a small company, but analysts are still looking for growth at that 18 to 20% level moving forward. But here's what I really like about the company. Their margins have, as they are growing, their margins are expanding. They've got a couple of distribution centers. It's certainly at some point, as they expand geographically, they're going to have to build more distribution centers to accommodate it. But for now, they're working out of the capacity that they've been building into those distribution centers. And as the management points out, as they're getting bigger in size, it gives them more leverage with manufacturers of consumer products. So now they can deal directly with them. So in a manner similar to what Dollar General does, where you see products that are manufactured expressly for Dollar General by leading consumer goods manufacturers. So it gives Ollie's a little bit of additional leverage that's going to help them continue to improve their profitability and stock their stores with merchandise. The merchandise that you'll find in an Ollie's, they have a big books section, which is pretty unique. They have some electronics, gadgets, etc., adapters, office supply kind of things. They've generally got a big department of cosmetics, shampoos, those types of products, toothpaste, toothbrushes, etc. They've got an auto parts section and hardware section. They've got kitchen supplies. They've got towels and bedding and sheets. They have some limited clothing typically, and then they have seasonal selections of Christmas decorations and holiday decorations, outdoor patio furniture and picnic barbecue type supplies. So the foodstuffs, it's all prepared foods. They don't have any refrigeration, so it's all canned and boxed and bagged foods. Again, and while there's you can always count on them having shampoo, you can't count on a particular brand that they might have. And so that's part of the fun, is you never know what you might find. And if they've got what you like, you might stock up on it. They have a great rewards program, and the customers who belong to the rewards program are spending significantly more than people who aren't part of it. So it's been very successful as well. So those margins are pretty solid. Compare these margins to, a Walmart, where margins are a third of this level. As we hit into, the 12% pre-tax profit margin, that's pretty significant for a retailer in this particular segment. We look at the back. My buy price is below $86. So the current, I think there's room to go. If you're do your research and you were to consider it, I think you've got some time. That the current price, that represents a 4.8 to 1 upside downside ratio, and the total return on an annualized basis, 18.7%. No dividend. This is a company that's busy expanding, and I've ratcheted down those high and low expected PE ratios to accommodate a little bit of a slowdown of growth from the past levels. But I think there's still plenty of potential here going forward, and I think this is a concept company that's got plenty of legs, will continue to grow, continue to expand geographically, and I think I like this particular industry group, because if we do have that recession, this is a defensive stock, so we can be establishing a position now that will help us when we do end up in a recession, whether it's 2019, 2020, 2021. So one of my ideas, so take a look at it, and as always, if you haven't subscribed to our SmallCap Informer yet, do check it out. Use the promo code Doug's Deal for the optimal savings, the lowest price that we offer on that subscription. our subscribers continue to grow, and our performance has been pretty solid compared to the Russell 2000 and the S&P SmallCap 600. So we have been delivering some solid performance results with our company selection on the small cap side. So if I don't see any questions, so we're going to wrap it up and get back to work, get back to watching the market. We'll look forward to seeing you at our next Lunchtime Stock Club. I've got a busy schedule this year. We're hitting a couple of new locations with the Money Show. We'll be in Seattle in June and San Francisco in August, and September at the Money Show in Philadelphia. So that's also new for them. I'll be in Florida a couple of times in February and March, in Orlando, Tampa, and down in Fort Lauderdale. I'll be in Cleveland, the Cleveland suburbs in April, and Iowa City in April. And then the Better Investing Conference in May in Chicago. So a lot of opportunities for in-person investor education at these particular places. Charlene says, would I sell Apple? Would I sell Apple? Apple is a company that's not always moved by fundamentals. There's a lot of emotion surrounding Apple. It's such a big company, and it's so widely held. It is, a major component in the indexes, so that provides a certain amount of stability to the particular company. Yes, they've been guiding downwards. From my perspective, this is not anything that is unexpected. At some point, we knew that, I think most people would have recognized that Apple was reaching saturation with $1,000 phones. The market is simply not there. Their margins have been going up, so I think that the direction of the business may need to refocus a little bit. We haven't seen anything beyond the iPhone, the iPod, the iPad, and then the iWatch, the iTV. These just haven't really panned out for the company. So is there something next that will augment the company's revenues? When we go back and look at what happened 10 years ago, the last time Apple had a kind of a major stumble and a sell-off, it eventually recovered. It didn't take very long. So investors who were holding we're looking at it. I know our investor advisory service covers Apple and hasn't made any recommendations to sell it so far, so they're continuing to hold it there. Beyond that, I don't personally have any particular interest in Apple or particular thoughts about the company. Certainly, look at your large cap stock exposure. It may be that this is from these levels that even with minimal growth, Apple has plenty of room to go. So you might take a look and do some challenges on it. There's nothing wrong with even if Apple goes back up from where the market is right now. There's a lot of companies that could have some pretty significant upside when the market takes a beating like it did at the end of December. Great companies get sold off along with terrible ones, and so those great ones, companies like Ollie's, got sold off, and I think it has quickly come back quite a bit from those lowest levels. So that's as much as I can really say about Apple at this point. Barbara says, what are the fundamentals of a company? Well, when we look at our stocks, we look at a company using our tool. We look at the growth of sales, the growth of pre-tax profit, the growth of earnings per share. Those are really key. For a company like a retail stock, we might look at the total debt. Ollie's total debt is 2.6% of total capital, so debt is not an issue. This is not a company that's got borrowing money to show growth. Other fundamentals, the pre-tax profit margin, so that's the percentage pre-tax profit on sales. Margins are including, that means every dollar they make, delivers a little bit more profit than it did last year. And that's a trend we like to see. We like to see companies that are increasing their profit margins. Likewise, their debt has been, they had more debt to equity in 2015, and that has been going down, so that's strong. They're reducing debt. That's really key when you're working in a low margin business. If interest rates are going up and you're dependent on borrowing for capital needs, then you can get squeezed. Well, Ollie's is working off of its the cash that it generates, and so it's able to expand while it's without borrowing money, and so that's really a great thing for the particular business. And so those are some of the key things that we look at. My focus is on the profit margin. So this, again, here's that graph of pre-tax profit margins. Companies that are able to do this without leverage, so they're not borrowing money to increase their profitability and expand the business. They're growing the revenues, they're growing the earnings, they're growing the earnings faster than they're growing sales by increasing the margins. So companies like this, we have a higher level of confidence that they're handling all the other aspects of the business: the occupancy costs, the energy costs, the shipping costs, the cost of staffing and employees. They're covering the basics of borrowing and cash management, and so those aspects go into, when you do the analysis, go into our assessment that this is a well-run business, and the fundamentals are giving us that indication. And so we can continue to look at a lot of different companies using this criteria, using our stock selection guide tool, and that will help us to find the best opportunities there. Mark says, what do I think about PGTI? I don't even know this particular company. But I've got my toolkit here, so we can go ahead and download it really quickly, if we can. Let's try this. PGT Innovations, basic materials sector, building materials, $511 million of sales last year. Well, we know that basic materials is a cyclical industry group. Building materials, especially cyclical. During 2008, 2009, during the last recession, we see sales declined. Earnings probably were greatly reduced, if not all the way to zero. We could do a little bit of analysis there. So with that caveat, we have to understand that in a recession, in this case, there are 3 years where sales didn't grow and the company wasn't making money. Investors tend not to like that so much. Sales growth 13.5%, including the impact of the recession and the recovery. So I think that's positive. A lot of debt, half of capitalization is debt. And again, that's something, and a lot of equity is debt, 181%. That we want to compare to the industry group, and see similar companies, how much debt they have. Debt to equity has been declining, so it looks like they're reducing their exposure to debt, which would be important depending on how that debt is financed. If it's tied to the interest rates of the overall interest rates, then their cost of capital are going to increase as interest rates go up, and so that would be part of it. Current PE ratio looks like it's selling at a bit of a discount, so I want to understand why the current PE ratio is under 14. It's been as high as 21 in the last 52 weeks. It's been as high as 22 in 2017. So there's some contraction going on the PE ratio side. Just could be concerns about the economic growth slowing and the demand for this particular company's products diminishing over time. So in general, I'm not opposed to building materials companies. There are some that are on my radar. I'm a little worried that, I know we have a 5-year perspective, but if a recession hits, these companies, will expect their performance to deteriorate. I would rather wait on some of these consumer cyclical stocks, maybe wait a little bit on them. But again, there's no predicting when that recession might hit. And so if we can get a company like this at a bargain near its let's look at Gentex. I think this is auto parts. So again, we're cyclical, and the auto industry. We cover Gentherm and Miller Industries in our SmallCap Informer. There might be another one or two. Not always my favorite industry. Anything related to auto parts, automakers, just because one, they're highly susceptible to what's going on in the overall economy, and two, they're highly susceptible to what's fashionable at any point in time. There's a lot about automobile purchasing that's driven by consumer preferences, much the same way that fashion retailers are often driven by trends that don't hold up over the long term. And so it just makes me a little nervous. Gentex is a company that I had an investment club 15 years ago that invested in Gentex very early on in its history. And it never really, it always seemed to be performing not as well as we hoped. And that seems to be the case as you look at it here. The red lines, Barbara asks what they are. Those are the trend lines. So that's the mathematically calculated straight line that fits the points on the graph. And if we project out our future growth, we will in this way. So analysts not very excited about Gentex going forward. Analyst estimate of 8.8% growth. So those red dotted lines represent now I have made some judgment decisions. I'm saying let's see how the company would perform if it grows at 8% a year, which is a pretty moderate growth rate, but that would encompass a recession where you would see is over here on the left side during 2009, where sales profits declined, earnings flattened out. They continued to make money. They just didn't see growth as fast as they did from 2010 onward. We can see a little bit of flattening out of the sales growth rate as up here in the since 2013. Gentex, for those of you who don't know, make the heated automotive mirrors and other technology for mirrors, rear view mirrors in automobiles with backup cameras, and heated exterior mirrors so they don't freeze up. And there's a lot of activity both regulatory and consumer demand-wise for features and products that Gentex makes. For instance, backup cameras are supposed to becoming mandatory in new vehicles. Some manufacturers like Honda have implemented them already, and so Gentex is kind of in that segment where they're working on products like that. So again, I think it's a solid company. Again, when you look at the price bars over the last 5 years, they just have not really, depending on when you purchase them, maybe you're showing a decent profit now if you were able to buy at a 52-week low or near the 52-week low, but there's not been a whole lot of upward drive for the particular company. And again, our investor advisory service does track Gentex, and they continue to follow it. They wouldn't follow it if they didn't think that the company was performing well enough to warrant interest by long-term focused investors. So that's all I can say about Gentex. I certainly wouldn't argue with anyone who said Gentex has got a great future. Earnings were up 35% in the third quarter. Sales were only up 4.9%. It looks like in the last 3 quarters, sales have continued that kind of flattened to flatten out a little bit. Just as evident on the graph, pre-tax profits have flattened out as well from 2016 to 2017 and into 2018, while earnings have gone up. That has all the earmarks of. This is interesting, an interesting observation here. My guess is if you notice the slope of the pink line, which is our pre-tax profit, and how it's been flatlining for the last 3 quarters, but yet earnings per share have been going up. Sales, very moderate increase. Earnings, a big increase. Well, how do you increase earnings per share while pre-tax profits are flat and revenues are up nominally? And the answer, I think, is they're buying shares back. And you can see the scale of the buying is hard to see on this particular graph, but it looks like they are actively buying back shares, and that's helping to boost earnings per share growth faster than pre-tax profits. And companies buy shares back when they've got cash that they can't deploy otherwise, or if they're in crisis mode and they're trying to support earnings while the business is not performing fundamentally as well as some people might expect. You can see just a very slight downturn here in the number of shares outstanding, and that might have continued into the last couple of quarters. Let's see, 288.2. Yes, if you look at the number of diluted shares as at the end of the third quarter, it was 267.6. So that's 21 million shares sold in the first 3 quarters of 2018. I'm sorry, 21 million shares purchased, reducing the total share count. And so part of that 35% earnings per share jump is not fundamental. It's just a matter of share buybacks. Share buybacks are great, but they're not sustainable, right? Because you can't continue to just simply buy shares back. At some point, the fundamentals have to be strong. You have to have sales and you have to have profits in order for earnings per share to increase there. All right, we're going to wrap it up now. I want to thank you all. Some great questions, great observations there. Hopefully some of my thoughts will stimulate your thinking on the stocks that you cover. If you want to, usually in our toolkit webinar on the first Tuesday of the month, we'll do a little bit more tackling of looking at stocks in the toolkit program and delve into the analysis there and solicit opinions. So if you want to talk individual stocks, and also our Stock Central website, we're always interested in having people post their stock ideas and research there for discussion, and that might stimulate some other thoughts on it. I want to thank you all for coming by today. Hey, and happy New Year to all of you. I'm optimistic about 2019. I think there's a lot of great things on the horizon for all of us in the market. So stay the course, and we'll see you next time at our Lunchtime Stock Club.